Okay, let's get right into it. There's a brand new tax rule hitting this financial year, and honestly, if you run a business, you absolutely need to know about this one. It's all about how you pay your suppliers, and trust me, getting this wrong could put a serious dent in your tax bill. We're talking about protecting your bottom line here.
All right, let me ask you a simple question. Do you work with small suppliers? I mean, of course you do, right? Most businesses do. Well, there's a new tax rule. You might see it called Clause 22 on your audit report, and it connects that very normal, everyday practice directly to your finances in a really big way. So let's break down exactly what you need to know.
Okay, so let's get into the nitty-gritty. The rule we're talking about is Section 43BH of the Income Tax Act. Think of it like this. It's the government's new way of putting some real teeth into making sure small businesses get paid. The whole point is to keep the money flowing to the smallest players in our economy, and the way they're doing it? By putting your tax deductions right on the line.
You know, the first thing to get is that this rule doesn't cover every single supplier you have. Not at all. It's laser-focused on payments you make to registered micro and small enterprises. And that word registered is the key. They have to have an UDIM registration certificate, which comes from the MSME Act of 2026. So, the big question is, what actually makes a business micro or small?
Okay, here are the numbers you need to know. For a micro enterprise, their investment in machinery has to be under 1 crore rupees, and their turnover has to be under 5 crore. For a small one, that jumps up to an investment under 10 crore and a turnover under 50 crore. And the most important word there is and. A supplier has to meet both of those conditions to qualify. This is your first step, your first filter for figuring out which of your vendors this rule applies to.
Okay, but listen up, because this is a huge exception you have to know about. This rule does not apply to traders. That's right. If your supplier is a wholesaler or a retailer, you're in the clear for this specific rule. Even if they have an MSME registration for other reasons, payments to them don't fall under this particular tax penalty. This was a really important clarification from the ministry, and it's going to simplify things for a lot of businesses out there.
All right, so you've gone through your list, you've figured out which of your suppliers are manufacturers or service providers, and they fit the micro or small criteria. The very next question is, when do you actually have to pay them? Because this is where the clock officially starts ticking.
So your deadline, it all boils down to one simple thing. Do you have a written agreement with them? If you don't, the default deadline is a super tight 15 days from when you get the goods or service. But if you do have a contract that spells out the payment terms, you can stretch that out. But, and this is a big but, you can never go beyond 45 days. That 45-day mark is a hard stop, no exceptions.
Let's just visualize this for a second. Imagine a timeline. Day 0, that's the day the goods arrive or the service is done. Then you hit the 15-day mark. The law actually calls this the appointed day. It's your default due date. Then, way out at the 45-day mark, that's your absolute final deadline. But remember, that only counts if you have it in writing. Go 1 day past your deadline, whether it's 15 or 45 days, and bam, you are officially late in the eyes of this new tax rule.
Okay, so what if you miss the deadline? What's the big deal? Well, this is where Section 43BH really shows its teeth. The penalty, it's not some little fine or a slap on the wrist. It's a direct, painful hit to your tax calculations.
All right, let's use a simple example to make this real. Imagine you've got a perfectly legitimate business expense of, say, 5 lakh rupees. You got some services done by a small enterprise. It's all booked in your accounts, everything looks perfect.
But what if you pay that 5 lakh invoice late? You miss that 15 or 45-day window. Well, that's when Section 43BH comes crashing in. For the purpose of calculating your taxes for that financial year, that entire 5 lakh expense gets disallowed. It's like it vanishes from your books. From the taxman's perspective, it's as if you never even spent it. The only way you can claim it is in the next year, whenever you actually make the payment.
And this is where you really feel the pain in your wallet. Look, if you pay on time, you get to deduct the full 5 lakhs from your profit just like normal. But if you pay late, that deduction is 0 for the year. And what does that mean? It means your taxable profit artificially goes up by 5 lakh rupees. You literally end up paying tax on money you've already spent. It's a direct shot to your cash flow, and it's completely avoidable.
Okay, so the stakes are pretty high, right? But here's the good news. Staying compliant is actually pretty straightforward if you're proactive about it. So let's walk through a simple 4-step action plan to make sure your business stays on the right side of this rule.
All right, here's your playbook. 4 simple steps. First, identify. You need to know who qualifies. Proactively ask all your suppliers for their UDIUM certificate. Don't wait for them to tell you. Second, check your agreements. Dig out those supplier contracts and see what the payment terms say. If there's nothing in writing, remember, the 15-day rule automatically applies. Third, track your dates. You need a system, whether it's a spreadsheet or a reminder on your calendar, to monitor these 15 and 45-day timelines for every single one of these suppliers. And finally, step 4, prioritize your year-end. As March 31st gets closer, you have to make clearing these specific payments your absolute priority. That's how you lock in that tax deduction for the year.
You know, when you take a step back and look at the big picture, you realize this isn't just another annoying tax rule. It's actually a pretty smart structural change designed to make the whole supply chain healthier. By making sure these prompt payments happen, the goal is to inject much-needed cash flow into small businesses, and let's be honest, they are the absolute lifeblood of our economy.
And that brings us to the final, most time-sensitive point of all. That March 31st financial year end, it's the ultimate deadline. It's your last chance to get these payments cleared and claim your deductions for this year. So the real question I want to leave you with is this. Are your payments in order? Now is absolutely the time to go through your books and make sure you are ready.